Hola class, how we doing? Chapter 12. Let's get to some questions, but before I do that, let me do a quick overview, and let me also give you a caveat. Of all the chapters in the text, if you want to say which one was the least in my wheelhouse, it would be chapter 12. This is something that I am familiar with, but have not had a whole lot of experience doing. So what I'm going to do is give you my opinion and what also I know from other people that have managed me as a salesperson, and also the literature of what I do know. Now, broadly speaking, you have to, and I know I've reiterated this a number of times throughout the semester, that in many cases, the salespeople in these B2B firms are responsible for like 100%, 95% of the total revenue of the firm. So keeping costs and measuring costs is an extremely important thing to do with these particular salespeople. You know, from a retention standpoint, a hiring standpoint, but also their expenses and everything else that's involved with this particular employee. Because they're not just a cost person, i.e. someone in marketing that has no, maybe they're working on the ad budget, that have no revenue component tied to them. These employees that work in sales, they are the revenue stream for the firm. And firing him or her may not be a good thing. Hiring a bad him or her may not be a good thing. Letting him or her go wild with their expense budget may not be a good thing. So we really do have to look at costs. We have to look at what these people both contribute from a revenue standpoint and also deduct from a cost standpoint. So what are some other major things I wanted to get to? Okay, cost analysis. Full cost versus contribution margin. Okay? If we look on page, hold on. Let me hit pause for a second. Alright, I am on page 419, but the easiest way to look at it is on slide 10 that I have up here on screen, which clearly looks at the full cost approach versus the contribution margin approach. Now, this is really something that is based on the firm. Obviously, the full cost approach is easier to calculate. It seems more intuitive. But for some firms, particularly ones that has a easier way to track fixed costs to particular products or markets, the contribution margin approach gives you a more fine-tooth comb to look at cost structure. You may or may not be able to do the contribution margin approach, and if you cannot, then you would use the full cost approach. For instance, let's say a company makes 5 different products, and they can easily track fixed costs to these 5 different products. They run on different lines, they're made in different countries, they are shipped to different marketplaces. Then yes, you would use the contribution margin approach. Many times, there's 5 different products, they're all made in the same plant, and they're made on the same line, and they're shipped to the same markets. You may not be able to do the contribution margin approach there, and it might be just simpler to bundle it all together and do full cost approach. Okay? See what else I wanted to go through here. Hold on, anything else in the slide deck? ABC accounting, activity-based accounting, contribution methods. I'm on slide 19, the major functional accounts that are useful in marketing cost analysis. There are a number of questions about this particularly. The direct selling, advertising and sales promotion, product and packaging design, technical, warranty costs, marketing research, inventory, packaging. When I have seen this, especially in firms that 100% of the revenue are coming from the salespeople, usually these cost structures are not attributed to one salesperson, but they are accounted for within a cost on the balance sheet. I mean, they have to legally. But some of the questions and some of the way the book is worded, it almost seems like, well, the salesperson that's in charge of this $50 million account, well, we're going to look at their direct selling, their advertising. No. These things are usually done for the sales force as a total and not per individual salesperson. These slides all go into that a little different. Okay, expense accounts, ripping off the company and T&E and expenses. This is clearly a challenge for sales managers and for salespeople. There could be a lot of gray here. There could be a lot of, where's the ethics and what's going on? Specifically, and I'm going to answer these questions now while I have the slide up, and I'll just highlight them again when I get to them. Usually firms are in charge of, you have a company credit card, so they see the total amount, right? You still have to turn in a T&E to justify what you spent. So firms that have less gray area are very, very specific to what can be included on a T&E and what cannot be, and what percentage of a T&E. So your travel expenses, if you're doing it by car and you have your own car, well, there's the number of miles, which have to be verified by Google Maps or some external source, and you get X percentage cents per mile. And if you're getting mileage costs, mileage, maintenance, and gas is all the same thing. You can't have a gas expense and get rewarded for mileage. The more specific the firm is, and the more the sales manager has a cultural norm for what is allowed, there's less of the ripping off. Now, there are other scenarios where there are firms, particularly with a salesperson that has one or two really big accounts. And they literally say, your expense budget is your expense budget. It cannot be more than 10% of your total sales. And that's it. So when you have something like that, whether someone's getting ripped off or not, point blank, you have a $50 million account. Your expense budget cannot be 2% of that $50 million. That's your number. Anything you go over, I will take directly away from you. Anything you go under, guess what? It'll come back to you. When I say take away from you, your commissions. If it goes under, you might get more money back. But this is your line. How you decide to do your dinners or your expenses, that's up to you. There are firms that do that, and they may do that particularly with very, very good, very, very high-powered salespeople that they don't want to lose. Okay? See if there's anything else here. Okay, there is one other question, and I'm on slide 34, the return on asset managed. And I have a question asking about the formula. And the formula was basically asking, well, sales is both in the numerator and the denominator. Okay? The short answer is, and I'm going to go through this question again when the question comes up, is actually it's not. It's a calculation using sales in the numerator, and it's a calculation using sales in the denominator. Because the numerator is a percentage, and you calculate that percentage using the sales number, but it's actually a percentage. And the asset turnover rate is calculated using sales to create the asset turnover rate number. So you have to do those two calculations, and then you get the return on asset managed. So it's not the same thing as having the sales numbers independent and they cancel each other out. The sales numbers are only used to calculate another number in the numerator. The sales numbers are used to calculate a number in the denominator. And then those two numbers create your ratio. All right, let's go directly to your questions. Do you know if the use of the contribution method is evenly spread across all industries? 55% of all companies use contribution method to look at a division. Or is it concentrated on certain industries, pharmaceutical versus consumer goods? I think the best way to look at this is not by industry, but by company size and number of salespeople and employees in general they have. You know, the simpler the scenario, the more it might be just a straight contribution method. The more complex, then you would probably use something. Actually, I think I just mixed those two up. Let me hit pause to make sure I say that. Let me start over. The easiest way to think about this is not by industry, but by company size. The larger the company, the higher the probability we're using contribution margin approach. The more complex or diverse the product line and the markets we sell into, the easier it is for us to find or trace costs to particular products or to particular markets. I don't think this is an industry thing. It's more of a company size thing. There are some firms that have to do full cost no matter what because they're too small and or their products or markets they sell to are not diverse enough. So here's my return on assets model concept question. And just to reiterate, as we see on the screen, sales and sales cannot cancel each other out because you need sales to calculate net contribution divided by sales. You get a number, and that is the numerator. And the denominator is sales over assets. And then that becomes the denominator. The sales and sales don't don't cancel each other out. So I think we can't look at the way the rest of this question is worded. The final equation is not net contribution over assets. That's not quite what we can do. Should sales analysis, category management of costs, return on assets be controlled by marketing or sales? Well, believe it or not, these are costs that usually the marketing and or sales department occur, but I don't know if controlled is the right way, but they probably do not get accounted for only in sales and sales alone. Meaning that the salespeople are not big enough or they don't have counts large enough to account for all the costs that are listed in category management to one particular salesperson or one or two particular salespeople. I think really it's accounting or finance that are doing the category management part of the equation that eventually goes down into the balance sheet. Sales and marketing are involved, obviously, because they're the ones that are incurring these costs. But the controlling, I think the better word is monitoring of these costs, is done more by accounting or finance. There should be a very, very strong dialogue between accounting or finance, whoever's doing that, and the marketing and or sales department that are incurring these costs. Questions. Are companies implementing new cost analysis systems, or are they using existing systems being enhanced, also used for cost analysis? To be honest with you, I am not familiar with any new systems out there. I know that there isn't a whole lot of innovation happening here. Of all the sales topics that I study or I see in the literature, or I hear people talking about, I really don't see any wildly new, off-the-wall stuff. Granted, again, this is not my wheelhouse. This is not my area of expertise within selling. But usually if something wild and new were to pop up, that information would be disseminated. Some professor would earn some kind of an award for a cutting-edge article, and I can't think of one off the top of my head. Cost analysis is complementary to the sales analysis and Salesforce management. Do returns justify expenditures? Now, when you say returns, I believe you mean sales returns. Well, the sales better justify expenditures, and we know when we're doing budgeting, many times the expense budget is determined from some kind of a forecast of exact sales. So how much are you allowed to have in trade show, advertising, expenses, dinners, whatever? Well, we expect you to do $250,000 this quarter. If you're doing $250,000 this quarter, you're allowed for up to 10% of expenses. So where is those 10% of your expenses going to go? I believe that's kind of where your head was at with this question. If there's something further that you had there, shoot me an email and I'll see how I can be helpful. So then I have two questions that are coming up, and I'll read them both. How do you achieve honesty when it comes to reporting T&E expenses? How do you deal with dishonesty? And the other question is, other than a company requesting receipts for T&E accounts, how else may they prevent employees from ripping them off? A lot of this is cultural norms. A lot of this is the sales manager knowing what is normal for that salesperson or that sales territory or those particular accounts. If a new salesperson comes in and with 6 months they have triple the expenses the previous salesperson had in that same territory with the same accounts, and the total revenue from that sales account has not changed, obviously there's a problem here. So that's what I mean by cultural norms. There should be expectations there. And a lot of it is also holding the salesperson, the T&E expenses. We need receipts. We need detail. And it used to be very, very time consuming in the past. But now we have these beautiful apps that literally we take our phone and we just take a picture of a receipt. We take a picture of something and it automatically gets inputted into the accounting system at the firm. And that's it. And you will get salespeople fudging less if it's easier for them to account for. Salesforce is just amazing with the stuff that they do. How often do you see individual stores or store managers in retail industry, for example, take full ownership and responsibility for the locations in their P&L statements? It's tremendously common. It is very, very common. It is. My neighbor across the street in this direction used to manage 2 different loft stores, and she was directly, that was her store. How well that store did was a function of the number of retail people were in the store, how much they spent, the cost, rent, all that. That was on her head. On my son's baseball team this year was the son of the CEO of Wawa. Raise your hand if you've been in a Wawa in the last week. Of course you have. Wawas are amazing. I'd always ask some questions here and there, and one of the things that he does on a continual basis as CEO is he goes into Wawa's because the store manager is responsible from a revenue stream on P&L completely. It is very, very common. Okay, next question. Research clearly indicates that promotional spending is ineffective. I may not agree with you here. It depends where in the sales cycle. If you have a new product or a product that is growing exponentially, remember you have cash cows, which is mature markets. That's when promotional spending is less effective. In a market that's in decline, dogs, that's when promotional spending is less effective. But in question marks and in stars, promotional spending directly impacts revenue. So I'm not sure if I agree here. However, if it is more of a one-time cost, shouldn't that tap into an unanticipated market that would have been hit if it wasn't for the promotion? I think it has a little bit more, there's more variables here. And the biggest one that I just alluded to is how fast that particular market is growing. How new is this particular product in a particular market? How much competition are you going up against in a particular market? Those have a lot of impact on whether promotional spending is effective or not. What percentage of total costs is made up of sales costs? That's a great question. It's a function of the firm and the industry. I hate to be this general. Please forgive me for being this general. But, you know, one of the clients I used to work for prior to get my PhD, I mean, this was a firm that had $250 to $350 million a year in sales. I mentioned them before in previous videos. They had 11 or 12 salespeople. The rest of it was an external sales rep. This firm, with a firm that size, has one marketing person. They have a VP of marketing, and that's it. That's it. So this firm is somewhat unique. You would not expect that. In firms that the B2B salesperson, a B2B scenario, you would expect that sales costs would be these are salespeople that are responsible for the majority of revenue stream. So here's a scenario where you have 8 salespeople on a firm, and they have to go to the trade show because this is where you get all the leads, contacts, then you demonstrate your products, wares, whatever. You know, you might spend, $1.5 million for over a 7-day period. And that's a huge number, and that's all coming out of the salespeople. But guess what? If the salespeople are the total revenue for the firm, then you would see a higher percentage of total costs coming out of sales costs. If the salespeople are not, and you have salespeople, but there's retail accounts and there's all these other things, well, then the sales cost has to be a much smaller percentage of total costs. How can companies better regulate the travel and entertainment expenses? I think I did that one pretty good. Are salespeople often responsible for mischaracterizing and overstating expenses? How should management deal with this issue? Again, this is a cultural norm, and these are managers monitoring. Sales managers monitor. There are probably strict percentages, and I've been talking about a percentage ceiling. There's a lot of firms that have percentage floors as well. That if you are not expensing to a certain amount, if you have a T&E account and you're using only 15% of it, that's also a problem. You're not out there with clients enough, and that's a problem. Do you find traditional marketing tactics such as TV and radio to be effective? In most cases, no. I'm not a fan of one way, top down. Here's an ad, I'm going to let it go, and it's really, really difficult for me to track the ROI. If you're a company like Apple and you have a $2 billion budget, then I have less of a problem with television. Radio, I find very, very, very few instances where I'm a fan of radio. I'm not a good, I would almost do billboards before radio. I would do podcasts before radio. TV, if you can do TV ads and it's only 20 or 30% of your complete ad budget, then I'm good with that. I do not agree with doing TV and it's 90% of your ad budget. If not, do companies continue to use these outlets when they're so much more expensive than social or digital? Well, I'm a bigger fan of social and digital. I think social and digital you can track easier. At the same time, the social and digital metrics out there, when I say these numbers are squishy, we have numbers. Okay, but what they mean and what they don't mean, a perfect example is I'm proud to say that I have a new podcast, you know? And I'll throw some numbers out there. The YouTube numbers are somewhere in around 450. My host's blog is somewhere around 4,500. The Facebook page is around 2,500. I think the blog from the social media agency that's sponsoring the podcast is around 4,000. You hear numbers like this and you say, oh my God, wow, 12,000 people or 10,000 people are watching the show. Well, no, they're not. In some of these we can see it's a 33-minute show and we can see how many people have watched past the first 30 seconds. And then you see that it's 10% of those numbers in the ones that we can track. So you have to look, the social and digital metrics that are out there, we're still discovering what they are and how to interpret those. But at least there's something. With TV and radio, you have those numbers are estimates. You back into them. You have to do research to find out what they are. I have more of a problem with that. What's the best way to determine ROI on marketing via social and digital? The best way to determine ROI is to decide what is your success metric. Okay? You know, that is the best way. Most times you think ROI, you're thinking return on sales. If sales is your success metric, then great. But sales doesn't have to be the success metric. It could be how many people signed up to be on your email list that you can then market to in the future. There are many content inbound marketing strategies that should be your determining ROI metric. Other people might just want impressions. Other people might want other things. But you have to determine what your success metric is. And then based on that, you then determine ROI on that. Not just sales. That's challenging. That's difficult. And sometimes you can determine ROI on sales. Many times you cannot. Because in the case of B2B, unless they're coming back and buying from you directly, then guess what? You can't determine ROI on sales. If you are B2B, which then goes to a wholesaler, that then goes to some end retailer, that's a whole different ballgame. And you can't determine ROI on sales via social or digital. It's too difficult. Okay, chapter 13 I am going to do in a separate video. Thanks. Turn this off. This is scary. Please don't tell me I've been talking all this time and nothing's been recorded.